subscribe now and press the bell icon. Never miss an update.
Okay, cool. So we covered all of that yesterday. Then we were at household employee taxes, and we saw that if if a person is employing, even though person is not running a business, is not running a company, he or she is not running any LLC, still the rule says that if you employ anyone at your home as a helper, household helper or babysitter or nanny or cook or anything else, and if they are being paid more than $200 per month or more than $2,400 during the year, then FICA taxes are applicable. So technically, there needs to be social security taxes that has to be deducted, and the family who is hiring that help has to pay it, and they have to do the reporting and all of that. The total, if the limit for future tax is $1,000, and obviously the person cannot do it in their own social security name, so they have to get a EIN number from the IRS, which is used to report employment taxes. EIN stands for what, Bhavani?
Employer identification number.
Good. If you are smart enough, you should have seen it here. But if you didn't see it here and you're still saying, then that's really good. Okay. So we covered all of that, and now we'll start with home buyer credit repayment. Now, this is something which you will not see very often, because what happened is, like, this credit was given only between 2008 and 2010, when the US economy was going through really bad phase, and all these, if you remember, there were big news of Lehman Brothers falling apart, and all the the subprime mortgage crisis that had hit US, because everybody was going around and buying houses. The loan was easily available at very cheap rate. So people, those who don't even qualify, those who really don't have that high income, or their calculation may not fall very well in place, still they were going ahead and buying, because banks were lending left and right, and that's how they sell the loan, right? They will give the loan to the individuals, and then they have all these loans which they will sell to Fannie Mae and Freddie Mac, and all these institutions used to buy in bulk and all. So, and suddenly the market fell, because various reasons the economy fell and all those things, and people didn't have enough money to basically repay their mortgages, and that's where this home buyer credit repayment was issued, that if there are people buying the home between this period, IRS will give, or US government will give, not IRS, US government will give certain kind of credit. Credit is always a benefit. So maybe they'll give $10,000 back or $15,000 back, whatever that amount is, that comes to certain percentage of the buying and all. So they will give that credit. It's actually an incentive, for people to go and buy homes, because everybody now, like, suddenly they stopped buying homes. So everybody, like, the whole economy can come down like that, right? The banking doesn't know what to do, and there's huge inventory in the market, the huge inventory of unsold homes. The prices are crashing. Unless the demand starts picking up, the prices won't go high. So all these things, this is all a circular kind of impact that has on the economy. So that was the time US government issued some initiative that, okay, if you are buying home during that period, we'll give you credit back, and that credit, that extra amount that you're getting back, you can pay certain amount every year back to government, and the time period given was 15 years. They can continue to repay it over 15 years, and Tanya knows it very well. We do one tax return for a client. I'm not going to say the name because this may go on YouTube, so we don't want to disclose names, but you know it very well, right? Every year we have to do this form 54.
Yeah, that $500 credit comes up.
Correct. And we have to, last time we were calculating how many years have passed by. Is it 15 years already and all?
Yeah.
So it's only people those who have bought home around that time we need to pay attention to if there is a home buyer credit repayment. This is also kind of tax because they're giving it back. It's kind of liability, not tax. But there's one more advantage given to the people, those who claimed the credit after 2008. They did not have to repay if they lived in the home for 3 years. So, again, this is meant for residential property. It is not meant for business properties or commercial properties. So if the home is not used for that purpose, if the home has been put up on rent or it is not satisfying the use of personal residence, if it's no longer a primary residence, then immediately the credit will be due to the government because that just beats the purpose. All right, I hope we all are clear up to here. Any questions so far? Because now we're going to start with FBAR and other financial assets disclosure topic, which is going to be different than the other taxes that we have covered. Okay, so we'll go ahead. FBAR, as you all know, or maybe most of you must be knowing by now, what does FBAR stand for? Or maybe if you don't even know the full form, it doesn't matter as long as you know the meaning of it. What is FBAR?
Ma'am, if anyone holds more than $10,000 in the bank account during the year, then he has to report it. It may
Yes,
be
absolutely. Yes, so this FBAR is, as they say, it's report of foreign bank and financial account. What is foreign to US is any bank account which is being maintained outside US will be considered as foreign. And US was the first country to impose this requirement. After that, a lot of countries had made changes and all the foreign assets and all those disclosures reporting they came into the picture because it was very easy those times, like 10 years back or 15 years back when they came up with FBAR requirement. Before that, US absolutely had no control on what people are doing with any income which was earned outside US because there is no social security reported there. There is no way for them to track. This is how people were hiding millions of dollars in all different countries with absolutely no responsibility to disclose, no taxes to be paid. And also US hit that problem. They said, okay, now what we'll do as one step to that, why don't we make it mandatory for everybody to start reporting their bank account, foreign bank account. So they are just targeting financial assets for now. FBAR is meant for only financial accounts and financial assets. If anybody has real estate or jewelry outside or some, maybe a huge collection of some, very expensive paintings or something else, they're not supposed to disclose that, even though it may have a very huge value. So this act, what they have, enforced, this is This is enforced by Financial Crime Enforcement Department. This is not by IRS. And the penalties are also very high. As the name says, this is financial crime enforcement. That means criminal penalties can be put up for non-compliance of this particular requirement. So it's very, very important. We tell our clients, is it FBAR applicable, not applicable? There are certain rules for it. What gets included as financial assets? How do you come up with a limit of $10,000? Is it at the year end? Is it maximum balance? Do we need to add up all the accounts? If husband and wife are filing their returns jointly, do we have to take joint threshold? Threshold on the joint financial accounts, or the other way around. And also all those things are very well laid, how to do that, what to do and all. But we need to understand that there is the penalties are very high. Criminal penalties can also be imposed, especially if there is a willful violation. Civil penalty is minimum, like it can go up to $14,000 or $15,000, and for willful violation it can be very huge number. or actually 50% of balance in the account. So US government has a right to come and take 50% of the money in the foreign bank account, even though you have paid taxes in foreign country. That would not matter. So it's always, we always have to, especially for the new clients, always make sure that we are looking into it, what they did in the previous years for FBAR, did they do it properly or not? If they have not received any notice, if they are not caught, there is still a way to go back and fix everything. This requirement is becoming very, very stringent. Okay, so, and we need to use the right foreign exchange rate as per given by IRS or as per given by Treasury to calculate if the amount in INR or any other currency or euro or GBP, if that translates to $10,000. So follow the guidelines. Like there are certain rates given for every year that you use those rates for conversion, and then see if you're exceeding $10,000. Even for like 5 minutes, if it gets above $10,000, we need to report that. Maybe the money will come in and just go out immediately. Doesn't matter. It has to be reported. Even if the person is not the holder of the account or not the owner of the account, but if the name is mentioned as a joint holder or as a joint signatory, then also it is required to be reported. Because lot of people, if their parents are getting old and all, they'll probably put up their name as second holder, saying that, okay, I don't want to give trouble to my parents. They have to go and sign all these documents and all those things, so they'll just put their name there. Doesn't mean the money belongs to them, but they just in order to help their relatives out. But unfortunately, as soon as the name comes, the requirement will also come up. So we need to be very, very careful about that. There are certain people, those who have US citizens staying in India, and they said that they are living in some apartment complex or some communities and all, and they've been made, all these societies are there, right, for managing the apartments affairs and all. So those society have pro bono positions. That means they're not getting paid, but somebody will serve as a president, somebody will be secretary, treasurer, and all. And if they become treasurer, they get authority on the society's bank account. You need to be very, very careful about that. They may think, well, I'm just doing volunteering work. I mean, it's really, how does US government has to get bothered by that? Yeah, true. Maybe they don't have to, but the way the law has been written, we cannot take any chances. They're clearly saying whether or not it doesn't matter whether or not the income belongs to you. That is not the scene at all. If your name is there anywhere, then it needs to be reported. Whether the income belongs to you and all, that is all a separate discussion that will all go in 1040, and how to report that and all that. We are not getting into that right now. That's completely a different thing to worry about. This is called FinCEN 114 report. We commonly call it FBAR reports. Every time we are finishing off a US return, you will always hear this word. Is FBAR filed? If FBAR is not filed, do not file 1040. They both get filed separately. They go to different departments. 1040 return will go to IRS, FBAR will go to Financial Crime Enforcement. So, and whatever deadlines are applicable for 1040, they'll be applicable on FBAR as well. Okay. A person may take up director position in a company and they get bank authority. Person is a director, not even a shareholder. The company is running its own business. All that money sitting in the bank account is company's bank account. Still, there will be a requirement because that person has an authority. It's all about control. It's all about authority. They have to go below, like they have to look into the substance, not into the forms. There is a very commonly this word has been used everywhere. Look into the substance. It's not forms anymore. On forms, on papers, you can put whatever you want to. You can design it in a way. Oh yeah, this is the holding company. This is the subsidiary company. Blah 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 blah. All those things. But now what US is saying is We have to look into the substance over form. That means who is the ultimate beneficiary? If not beneficiary, who has the ultimate control? Control is very important now. You may take only 5% shareholding in a company. Still, you may have big control over the company. Why? The way you design it and all. So they are not going with the numbers anymore, that if this person is a 5% shareholder, well, they consider to be a minority interest person. So yeah, they, we can easily say this person is not in control. No, I mean, on purpose, maybe the person is keeping only 5%. Maybe they're designing it a way. Maybe it's been given to friends and families or whatever, or to somebody who doesn't even fall in the definition of family for these purpose. We have to see who is running the show, who is having control, who can influence the decision of the board and the management. That is the person who will be in control. I'm taking a bit more time on this thing because this is really important. We cannot miss on any of the FBAR compliances. Okay, the penalties are very, very high, and the waivers are not possible. So there's something called specified foreign financial assets. This is linked to FBAR. And again, the only difference is thresholds. FBAR has a threshold of $10,000. 8938, this specified foreign financial assets, they get reported on form 8938. It's an additional reporting to FBAR. You can just think that FBAR is a very basic level reporting. On top of that, there's 8938 reporting. That means if your balances are very high, or they're crossing the threshold which is given for form 8938, then we need to report that to IRS. This is not reported to financial crime enforcement. Let's pay attention to this. This is a form that needs to go to IRS. So this will go with 1040, our regular return. Non-filing of this form, there's a $10,000 penalty. Again, very, very high, and it can go up to $50,000. So it's really doesn't matter whether you may have just like, I mean, the person may have $10,000 income. Absolutely no income during the year. It's not about hiding income at all. It's not about saying that the IRS is not just about hiding income and going after those people. It's also about hiding assets. Maybe those assets are not giving actually any income, so you don't have to pay income taxes, which is fine. But even the assets should not be hidden. That's what the aim is. This is again, if you know that whenever you're working on FBAR, whosoever is working on FBAR, whether that's Sai or Bhavani or Divyansh or anybody else, you always we need to have an open mind. You just don't take the numbers, okay, above $10,000, report it and all, boom, done. Have an open mind. See what is the balance. Maybe it is exceeding $200,000. Maybe it's exceeding $500,000. If it is, it should immediately strike us that, oh, there could be a 8938 filing requirement. Put a note for the preparer saying that you're working on this client, their FBAR balances are very high. Maybe look into the 8938 possibility. Now, again, I'm not talking specifically about threshold here because threshold will differ from filing status. It will also differ for the people, those who are living in US versus people living outside US. So let's not get into that thing. That you can easily go and Google. You just do a search for form 8938 instruction. It will give you threshold. But usually it is like around $50,000, $100,000. So if you see any FBAR assets, financial assets above $50,000, immediately, at least we should put a note in our file that, check if 8938 is applicable. See, if we miss reporting any interest income, dividend income, it's fine. It's not not that big of a deal. But if we miss reporting FBAR and 8938, it is really a big deal. because of the penalties, because this is governed by crime enforcement department. We don't want to get any notices from them. If we miss reporting an income, at the most IRS will say and come and say, hey, you missed reporting this income. We are adding this to your income. This is your extra tax. On top of that, now you have to pay interest, penalty, whatever. Fine. If we agree with them, we go ahead and pay it and we are done. There is no criminal penalty there. Okay. So, yep, that's it here. We'll probably in one of some other chapters, we're going to go in detail what needs to be reported and all. But right now, all they want to do here is just touch on these topics.
Ma'am,
Yes.
is it applicable for NR also?
No. It is only applicable for residents. But what we need to remember is these are all financial assets. Financial assets can be anything, which can be a simple bank deposit to an insurance policy, to mutual funds, to stocks, demat, some other kind of chit scheme where people put in money, anything which is actually not real or anything else in nature.
Okay,
It
ma'am.
has a huge list. It can include a lot of other things. So that's what I was saying, that we will not get into what it is includes and what not and all. But right now we are just focused on if there is a requirement, or how do we figure out that there is a requirement, and if there is a requirement, we need to file this thing. Generally, all the assets which are included on FBAR will be included here, but it can have more as well. Okay.
Okay, ma'am.
Yeah. Okay, then we'll this chapter is done pretty much. We'll start with something new now. So let's go to tax credits. All right. So can anyone tell me, Tanya? Maybe you can tell me what are the tax credits? What is meant by credits?
Credits are something you get a deduction on your tax liability, but you don't get refund. So it
Okay.
is only maximum to the amount of your liability, but it's not like you'll get a refund in excess of that amount.
So Shweta, is that right? Can there be refundable tax credits?
It's like we get like more than if there's a liability which and tax credit is exceeding that liability, we get a refund of the amount which is the leftover.
I think both of you are right, partly.
I
There's,
okay,
there,
I think I messed up. So there are some refundable and some that give a deduction. Like FTC is only up to the extent of liability, but like child tax credit and education credit is refundable. Correct?
perfect. Yeah, obviously. So yes, that's why we see so many clients getting refunds, right? Why would they get refund if they're not paying any taxes? There are refundable credits. These are the refundable credits. If you are eligible for these credits, it may also give you a refund back. That means you're actually not paying anything to IRS and you would get free money back. But these credits, these are non-refundable credits. And these would reduce your tax liability only to the extent, I mean, these would reduce your taxes only to the extent you get tax liability. We're not going to go negative on that, meaning it will not result into refunds. So child tax credit falls under non-refundable, but there's something called additional child tax credit that comes up as refundable. We always see this ACTC in our form, and that all comes 1040 page 2 in the bottom section. You will see the refundable credits. Okay, so these are all kind of credits that can reduce the tax liability, and this is a direct deduction of tax liability. It is not a deduction on the income. It is not an adjustment that our income gets reduced by so and so. Like if you put money into retirement plan, your income gets reduced by that retirement plan money that we are putting in. For example, 401k. or standard deduction, that is reducing the taxable income, but it is not giving a credit. Credit is something that straight away reduces the tax liability. So let's go over some of the tax credits. The first one is foreign tax credits. That's really, really important, especially for us, because all of our clients we're going to have foreign tax credits. And this is the term we use all the time, FTC. What is the FTC on this? What is the FTC on that? Like how much FTC has been used. Okay, so FTC is really important. And what they're saying is everybody is eligible to get a foreign tax credits, even pass-through entities, which will mean partnerships or S corporations and all. It's just not meant only for individuals. Usually, like think about it logically, the FTC is given only to residents of US, because why would IRS bother about giving foreign tax credit on any income which is not even coming up as taxable in US? It's just out of question, right? That the math doesn't work there. If you're not reporting any income for taxes, how can we claim foreign tax credits on that? But there can be certain situation when a non-US person is also claiming foreign tax credit. How? Because if that non-US person, it might be a resident, sorry, might be a non-resident, but if that person is earning any income which is effectively connected with the conduct of trade or business in US, that means that becomes US source income. Then one can claim foreign tax credit. So to put it properly, any income which is a US source income or which is taxable in US, that income will qualify for foreign tax credit. If the income is not taxable in US, doesn't matter how much taxes you have paid. Why would IRS be bothered about it? Because they said, fine, you want to pay 0% tax somewhere else, pay 0%. You want to pay 50% tax, pay 50%. It doesn't matter to us because that income is not taxable in US. Okay. QFT is qualified foreign taxes, any of the taxes which is paid in a foreign country. So we have to, that is very important. What is the percentage of tax or effective tax rate in a foreign country? We can go with effective tax rate. We can go with actual tax which has been paid there, as long as it is reasonable and it is close to the reality. Sometimes it's not possible for us to accurately come up with the tax liability in a foreign country. That is fine. What IRS says is as long as it is reasonably calculated. Sometimes we don't have the information. That what they look into is the conduct. There should not be any willful misconduct there. The intention should be to report everything. If the numbers don't tie later on, if they come to know right what you have reported doesn't tie and all, one can always say that okay, to the best of my knowledge and information, I'm reporting this. It's possible that it get changed later on, which is fine. We can always pay more or get a refund back, but that is not the reason to say that I don't have accurate information, that's why I don't want to report this information. It's very clearly said everywhere, if you don't have accurate information, just put whatever is reasonable, and file the taxes. Later, if you get accurate information, go ahead and amend it and make accurate filing. If it is changing something materially, if it's not changing materially, we can still stay with the same file. So there is a formula on how foreign tax is calculated, foreign tax credit. It's very different than how you guys do it in India. In India, probably will just take what is the actual number of amount of taxes paid outside India, right, and then apply it to what would be the tax rate in India as per DTA. If there is a double tax, double tax like a avoidance agreement signed or the treaty signed between two countries, we just have to see what is the maximum tax rate that can be charged on that kind of income And based on that, India is going to charge, and then we can just claim the full tax credit for the amount paid outside. US doesn't work like that. We always have to take a ratio of foreign earned income with the worldwide income and see what is the foreign tax credit that will be calculated. So a lot of times people will come and say, well, I've paid, like, if you really see, I've paid almost $100,000 as tax in India, but you're giving me a credit of only $40,000. I should get the entire money back. True, but there is a treaty between US and India, so we can even claim foreign tax credit. But the way it works is we have to go with whatever the formula US has given or whatever the law that they have put up. We have to take the ratio of foreign income to the worldwide income and see what that comes to, and accordingly that ratio gets applied on the foreign tax credit, and foreign tax credit may get reduced. So if the person is having very high foreign income and less domestic income, domestic meaning US income, then obviously foreign tax credit that they can claim will be high. If the person is having low foreign income, very high domestic income, then foreign tax credit gets reduced. Because what US is saying, what IRS is saying, we will give weightage to the income, to the source of the income.
Hello.
If it's foreign source income, yes, you get more weightage. Accordingly, your foreign tax credits will go high. If it's domestic source income, you get less weightage on foreign income, so foreign tax credits will go low.
हमको पेन ड्राइव तो देते हमारे इसमें तो कॉपी करना
The good thing is that those tax credits which we are not using, they get carried forward to next 10 years.
झूठ बोल रहा है
Okay, there is form called Form 1116. Again, very, very important form. Every tax return you'll see will have this form. And we need to make sure all the foreign tax credit is claimed on this form. All numbers are properly given. We have to give the nature of the income, whether it's capital gain income or passive income or active income, and give the foreign tax credit corresponding to that income. Foreign taxes, I mean, corresponding to that income. The software will do its calculation and it will tell how much it is applicable and not. But remember, if we don't do the input part is not done directly, then we cannot blame the software. Whatever we put in, the output will come according to that. So if there is a foreign source income and we don't mark it as foreign source income, it will have an impact on foreign tax credit. Or if there is a US source income, we accidentally go and mark it and we say, oh yeah, this is foreign source income. Again, we may end up taking more credit, and if it opens up in the audit, there could be trouble. So the basic input has to be done by us. We need to understand where this income is coming from. Is this domestic income? Is this foreign income? Am I putting it properly? Not just that, to whom that income belongs to. Does that belong to the taxpayer? I mean, both husband and wife can be the taxpayer, but for simplicity's sake, we call the first name which comes on the form, we usually call that person as taxpayer, and the second person can be spouse. There is no such rule that only husband name has to be there as the taxpayer and wife name will come. It can be any way we want to put it. Typically, the person who is earning more, that person will become taxpayer. So again, it's very, very important when we are entering interest income, dividend income, we need to mark it properly. This income belongs to taxpayer or the income belongs to spouse. We have seen a lot of mess up happening because of that, because it has not been marked properly. Additional Medicare taxes came up because what we are doing is we are not paying attention to W2. We just went ahead and we marked everything as taxpayer's W2, even though it was issued in spouse name. So the person ended up paying additional Medicare taxes. And we figured that out later. But on the face of it, we cannot come to know, right? When we are looking into 1040 form, we are saying, yeah, W2 looks okay, fine, interest income looks okay, capital gain looks okay. That means we have captured everything. So the work of the preparer is extremely important because that is the person who will be putting in the information. in the software. The reviewer may miss on it because when they're scanning through it, they may not be able to review properly again. So, we need to be extremely careful. So we were talking about foreign tax credit. Yes, Form 1116 is used there. It can be the tax credit can also come on Schedule K1 or 1099 interest and all. That doesn't matter. There could be tax credits on K1 if the K1 relates to foreign income. Anything that relates to foreign income, even though a 1099 may be issued by, say, Charles Schwab, which is a US brokerage firm, but they can still mark that as foreign income. Why? Because probably they put that money in some foreign mutual funds and they're getting return. And they also ended up paying some taxes there. So that means the taxpayer did not go out of the country and say, hey, I want to put my money into these UK based mutual funds or in Singapore or somewhere else. No, the brokerage company can do that. They can go ahead and put money into anywhere they want to. Wherever they see, oh, they'll get good returns for their clients, they'll go ahead and put the money. And with all this liberalization, globalization, and all these things, it's very easy to do the cross-border transfers and also. So again, even though it's a 1099, don't be under that assumption. Oh, this is a 1099 issued by a US company, so it has to be US income only. Let's not go with that assumption. It can very well be connected with foreign income.
Ma'am,
Yes.
what is K3? Schedule K3?
What? Schedule what?
K3.
K3. Schedule K3 is for foreign income only. There's an extra information that goes on K3 if the income is coming from a foreign partnership or foreign LLC and all. We need to work on Schedule K3 as well. If it's a simple US based partnership firm or LLC and all, it can be simple K1 only. But K3 will usually come into the picture if it has to do something with foreign based companies. Okay, K3 has a lot of those fields where we need to put in what is foreign income, what is the foreign taxes, foreign gross income, foreign expenses, and all those things.
Okay.
Okay.
Carryovers,
we believe that
from foreign income. That is what you're saying, and then we use Schedule K3, or the filer is having foreign partnership or something like that. Because for foreign partnership we use 8865, right?
yes, that is again a disclosure. That is like 5471 or 8938 form. That also has $10,000 penalty if you don't disclose it properly. See, what people may do, they may say that, oh yeah, I'm including my foreign partnership income in my 1040, and they may also have a K1. They just put some K1 and all, they just put it. But they may still get penalized if they don't file 8865. So 8865 again is an information reporting form. Like how 5471 is. No tax is being calculated there. It's all only for information reporting purpose. So that's what 8865 does. But 8865 gets into the K1 and K1 flows into 1040 and that's how we do calculate that. K3 has to do, you just need to remember K3 has to do with foreign income. Anytime there is a foreign income, you will see a K3. And that we'll see with a lot of K1s that we receive for other clients from, say, they must have put money into some Mauritius-based funds or some Singapore funds, and where they're getting, or in Dubai, a lot of people are putting money into Dubai. We have few clients also doing that. So they get K1 from those companies. And besides that, there can also be a K3 statement that may come with K1.
Okay.
So carryover, we saw that again, it can be carried forward to 10 years. It can also be carried back by 1 year. usually in chronological order. We'll go in chronological order. So that means if we have remaining tax credits or foreign tax credits, we can always use it in the future years. Or if we don't need to go back and open a previous year and all and need to apply there, that can also be done. So yeah, this is very important point. A credit cannot be taken for foreign income taxes paid on income that is excluded from US tax. Again, it's very, very logical point. We don't even need to understand the law there. It's very logical. What US is saying, if you are not putting any income as taxable, okay, then you don't even claim foreign tax credit on that. So let's go over this example. Maybe that will help us, understand the foreign tax credit part. So, Ayush, example 8.1.
Yes, madam. When Maria had an AGI of 100K in 2022, of which $80,000 was wages earned in the United States and $20,000 K. 20,000.
20,000. Either you use K or you use 1,000. Okay.
Yes, ma'am. Dollar 20,000 was unqualified foreign dividend income. She paid $4,000 of foreign taxes on the dividend income. Maria's 2022 tax liability before the FTC is $15,000. The portion of US tax liability assigned to foreign income is $3,000. Dollar 15,000 into dollar 20,000 divided by dollar 100,000. Maria is able to claim a $3,000 foreign tax credit on Form 1116 and has $1,000. Dollar 4,000 taxes paid, $3,000 minus $3,000 allowed credit of unsaid foreign taxes credit that can be carried back to 2021 or forward through 2032.
Okay. Let's look into the facts again. She's having an AG of $100,000. 80,000 she earned in US. 20,000 came from foreign sources. Okay. So we need to have the breakdown. What is the total income? What is from foreign source? What is from domestic? 80,000 comes from domestic sources, 20,000 from foreign. She paid 4,000 in foreign taxes. Maybe she's paying 20% taxes in foreign to, like, she must have paid 4,000 on her dividend income in some foreign country. And her tax liability before foreign tax credit is $15,000. But she has already paid $4,000 in some other country. So we need to see, can we take the entire $4,000 and reduce her tax liability? Maybe we can take entire $4,000, reduce it, from 15,000 and make it $11,000. Can that be done? No, because we cannot take absolute numbers. We have to go with the ratio and the formula given. So the portion of US tax liability assigned to foreign income is 15,000, which is going to be her tax liability, times 20,000, which is a foreign income. This should be in bracket, the 20,000 divided by, because this is the ratio that we are looking at. 20,000 divided by $100,000. 100,000 is the total income. Now let's look into it again. Foreign earned income divided by worldwide taxable income. They are not saying you take foreign income to US income. They take foreign income to worldwide income. But I mean, in order to come up with foreign income, obviously we need to know what, out of that worldwide income, what is foreign, what is domestic. So this is the ratio they are taking. 20,000 as foreign income divided by 100,000, which is her total income. And what is her total tax liability? 15,000. So if you do that, can anyone do this calculation? It will come to $3,000. And 3,000 is the foreign tax credit that she can take on Form 1116. That means she can reduce her tax liability by $3,000. So now, after foreign tax credit, she has to pay $12,000 to IRS because she is getting a credit of 3,000. But she is actually paid 4,000. Right? She has actually paid 4,000. 4,000 is the money that went out of her pocket. That is a real expense for her. But US is giving her benefit of only 3,000. What US is saying that, yeah, we understand you have $1,000 extra that you have paid. But sorry, we cannot allow you. Not in this year. But you take that as a carry forward amount for next 10 years. 2022, so she can use it anytime next 10 years. If you want, you can use this $1,000 or carry back 1 year. So this is again important for us to learn. These are the basic things that if client comes and tells us that, well, I paid so and so, I'll get full credit, right? I should not have any liability at all, right? Like, I mean, whatever it is, you will reduce it. This is the tax I'm paying. I'm not making it up. I'm paying a lot. This is all these things you will listen a lot. Like, oh yeah, my tax bracket, I'm paying almost like 40%. I'm paying a lot. On top of now, I don't want to pay anything to US. We need to say, yeah, we understand you are paying a lot, but we cannot tell whether you have to pay to US or not. We have to see your total income. Your total income from foreign sources, from domestic sources, we have to see that. We have to see what is the ratio of your foreign income to your total income, and see what is the maximum tax credit you can take. We cannot tell very confidently, yes, you have paid all these things, you will not, US is not going to tax you. Don't ever do that also. Always run your numbers. We have the software, we have all those Excel templates. Run your number and tell. Okay, so we'll stop here now. Those were very, very important, very practical topics that we went through. We need to, everybody, all of us, we need to understand what is Form 1116. That is very important form. Okay, we'll just stop here and tomorrow we'll continue with education credits. That also we need to understand who can be eligible for it, can they get credit or not. Even after paying a lot in tuition expenses, still a lot of our clients may not be able to take any advantage. Why? And all we need to understand all of that. Okay.